This is our video blog for February 1st, 2011. One of the first things we do each day is look at our currency meter and find which ones are strong and which ones are weak. And we buy the strong versus the weak, and we sell the weak versus the strong if the top currency is the weak one. So you can see the real-time weakness last night of the dollar, the weekly and monthly trends down, and you'd like to find a strong currency on the bottom to buy against that. Here you have the Australian, which the weekly trend's up, the monthly trend's down. In the best of all worlds, the weekly and monthly trend match. You can see a couple hours before midnight the Australian got strong, the dollar was weak. That was one opportunity. The pound had a lot of strength here and also had a ridiculously strong up move yesterday. It was up kind of too much and maybe not as likely to explode up today unless it consolidates sideways for a while. Usually after big moves up, the market either goes sideways or has a pullback, or it kind of has a bumpy ride going higher. It's not one of those trades where you get in and catch 30, 50 pip moves. Usually you at least need 4 to 10 hour sideways, very tight rectangle breakout before, that's a high probability. Because the pound went up so much yesterday, pound dollar, it was, needed either a pullback to get into the trend or a sideways breakout, which did happen later today, but last night it needed a little bit more time, so I personally wouldn't have considered that one. So let's look at the Australian dollar. You can see a couple hours before midnight, this one was above the hourly, the daily, weekly, monthly trends up, and previous week's high apparently is right there, and when it breaks out, the trend just continued. It went up about 137 pips. You might have got into this trade here, exited with about a 15 pip here. When it pulled back and didn't go back into that range, this NR breakout pullback right here is a pretty decent place to get in. I would have got out right here at the Fibonacci retracement area, and you can see it's increasing its momentum on the way up, not that much weakness. When it's at or above the upper containment band, usually you want to wait for at least a couple hour sideways move before you get in. If you had bought this breakout right here, which I might have done, that's sideways for about 2 hours, went up a few pips and then came back down, you would have got stopped out. The second trade you got in here, the next area that's likely to be resistance is either the weekly pivot or the fib level. We have a Fibonacci profit target level right above it as well. So if you hadn't got out of half here, you would have exited your whole trade here at 75. That trade was good for about 35 pips. And again, it's not off the charts strong. It's usually risky buying pullbacks at or above the upper containment band. It's better to kind of wait for a couple hour sideways range. So it kind of went sideways for a while. You might have anticipated a breakout here and got in when it broke out of this bar's high, and then you had a trend reversal triangle here, which usually is the end of the move. If you want to take quick 10 or 20 pip scalps at or above the upper containment band, that's permissible, but usually most of the time it doesn't explode up another 60 pips like this one did. But the currency meter showed you the Australian was strong pretty much all day, and we had a weak dollar, and you might just want to get into those trades and hold them until you see any signs of weakness coming in. Another one that was strong, it had brief amounts of strength last night. It was in New Zealand. The weekly and monthly trend also match it. And the same exact thing. And our breakout right here kind of went up and ran out of steam right here. There's not a whole lot of statistical momentum, so you might have got out of here. And this is what I'm talking about with, when currencies are strong and they go sideways for a couple hours, the longer the better. I prefer 2 hours minimum for taking a chance on this kind of trade, and 3 and 4 hours typically work. You might have got into a trade here, your stop's right underneath the sideways consolidation, and then it finally breaks out. It's possible it's going to find resistance here, here, or here, and it goes up to upper containment band, kind of runs out of steam. It doesn't have the plus 20 strength, which usually is necessary to go through these upper containment bands. So you get out of that trade with maybe 15-20 pip profit. This isn't much of a pullback. If you had got in here, you might have made 10 pips on a scalp. Here you can see it went sideways for about 2 hours. So you bought that breakout right here with your stop underneath there. It went a few pips your way, came back, didn't stop you out, and then when it took off, you always got to be aware of where the fib targets are. Draw your fibs on the last move. and look where it went, right to the fib target. So, when you're at or near or above the upper containment band, sometimes you're going to make 30 or 40 more pips by being dangerous and reckless and hanging on to trades, but most of the time you're going to make the most money by just simply getting out at the fib target. You bought this trade right here when it broke out, 58, went a little bit your way, came back, didn't stop you out, and then it came back up here. You only made about 20 something pips on that trade. And I wouldn't have bought this pullback here because there was a lot of weakness there. Once the market went up again and pulled back in double bottom right here with less weakness, it becomes pretty safe to buy this. This keeps making higher highs. That's a sign of a currency that's going up when it makes higher highs and higher lows. You can see the lows just keep making higher. And when support areas like this hold, especially with a double bottom right here with less weakness than before, half the weakness, pretty high probability here. And again, you don't know where it's going to go. I'm going to usually draw my fib on the last wave, and I probably would have got out of the whole trade right here at 96. But somewhere in here around 60, 35 pip move. And I personally would have missed the remaining 20 pip move. That's just the way I trade, But if you have the ability to be a little bit more cautious and just kind of trail your stops when it gets above the upper containment band, especially if you see the weakness kind of subsiding like that, it's best to usually get out of the trade. Let's look at some of the other currencies. Our Fibonacci profit target levels are excellent profit target levels. This one kind of broke out and had little pullbacks. You might have had a few scalp trades in this. I shorted the euro yen myself last night and made 12 pips. It was kind of consolidating. It had a false breakout. The resistance area, the Fibonacci retracement areas right here. So I know there's likely to be major selling right above me. It came back down. It's just kind of going sideways right here, and I got short pretty much right here when it broke. And at the time when I was watching this and it came down, I got out somewhere around 112.9 or so. No, actually 112.11. I was watching the euro dollar tick chart as well as the tick chart on this one, and the euro dollar started to spike up while I was short this, which is showing you basically the euro stronger than the dollar, and this one just kind of stalled there, so I got out with 11 pips, and I didn't, it was pretty dull trading at the time, so I didn't continue. But when this currencies are underneath the hourly, more likely to go down, and again, when you draw your fibs on previous waves, usually you can find the area where it's going to stall. Here we have the 200-day moving average, major support, and it's in the Fibonacci profit target zone of the first wave. I wasn't trading. I quit trading at 4. Matt was tired, and it didn't appear. Sometimes currencies need an hour or two to set up before there's a really low risk, high probability trade, and I didn't see any trades I would have wanted to take without seeing a currency go sideways for about 30 minutes or pulling back and hitting resistance. So I stopped trading at 4. Here we have a currency with the daily, weekly, monthly trends up. This is a pair last night that I wanted to get short right here. It was right at or near the 4-hour statistical high. You can add that to your chart by doing the range projection. Currencies that hit, and I saw this trade, but I didn't take it. I'm mad at myself for not. You put the 240-minute statistical high on here. You can see at the 4-hour statistical high, it went a little bit above it. There was a Swiss economic report here, 315, which caused the move up. But the longer-term trend is down, and usually you can get short at the upper containment, either the upper containment bands or the 4-hour statistical high. You can see our counter-trend sell signals right there, and the market pulled back pretty decently. If I had taken that trade, I probably would have exited right here at the hourly around 20, but I was really considering shorting this around 38 to 40. Would have been a 15 pip move, but I was watching the euro yen at the time and missed this one. Anytime these levels get hit and they go above our 4-hour statistical high, if the longer term weekly and monthly trends down, you usually have a pretty high probability of short. Just like when you have the weekly and monthly trends up and the currencies go down and hit the lower 4-hour range, which might have happened in this chart. Let's just add it to the chart and see. It did make a pretty decent sized move down. It's possible it hit the 4-hour low. Yeah, not quite. It went just about 6 pips away from the 4-hour statistical low here. When the longer term trends up, it's usually a pretty decent place to get in. But this one came down, hit the hourly, found support, and when it broke out right here, because this resistance area already got broken out before, pretty decent place to get in. And notice where it went to, the 4-hour statistical high. That oftentimes makes a good place to, and it's one of our counter trend methods, and it shows you those circles on the chart even if you don't have the 4-hour statistical range on your chart. I wouldn't have gone short here, but when it double topped right there with a little bit less momentum, you know, it's not a bad place to get in for a quick little counter trend move. Getting back to this, you know, at 4 o'clock we had incredible weak CAD, and the weekly and monthly trend is down in it, and the yen is very strong. The weekly trend's up, so you had a really decent sell in the CAD yen, looking around 4, coming up to 4. You can see this one was above the hourly. You have a narrow range 7 pattern on here. Usually those breakouts cause some decent moves, and when it gets short right here, it found support, but the second time it broke through, fell about 40 pips. And again, unfortunately, this happened a little bit after I went to you know, quit trading. I would have definitely taken this trade. Anything that's in the direction of the weekly and monthly trend, it's, you know, just high probability trade. And you can see the real meat of the move happened at like 4:20. You go back to our currency meter and you look at here, 350 started to show incredible weakness. So about 25 minutes head start before that CAD yen exploded. And right before 4, you can see that the yen already had strength as well. So anytime you see a pattern type breakout and you have our currency meter, you know, where one currency's weekly trend's up, the real-time trend's up, another one's weekly trend is down, the real-time trend is extremely down, and it always helps to have the monthly trend in that same direction. It's pretty much a no-brainer. And you can see last night was a pretty dismal trading night, but this is a pretty decent 10, 20, 30 pip move down, and it went right down to our lower containment bands. And I would bet that if you added the range projection to this, it probably hit the 4-hour bars average distance, and you know, that typically oftentimes is where prices stall. I didn't quite hit our containment bands, which are, you know, different formula. Here was the average 4-hour low here at 55, and it got all the way down to about 59, 60 or 59. It was 5 pips away from there. So you may or may not have gotten out of it with this kind of momentum on the way down, but when it double bottomed right there with almost no weakness, you know, decent place to get out of that trade. Take whatever you can get. And if the weekly and monthly trend were up here, anytime you see a double bottom near the 4-hour range low or at our containment bands or any kind of other support resistance, double bottoms with this kind of divergence where you don't have that much weakness the first time and you don't have any weakness the second time, or in this case you had incredible weakness that all but disappeared. That means the CAD, which was extremely weak, you know, at 4, over here at 6 o'clock isn't so weak, and you can see that on our currency meter too. Or the, you know, it also might mean that the yen, which is off the charts, weakness here or strong here, was a little bit less strong. You know, you can see at 6 here the weakness started to subside. Right here, 6:10. You know, if you go back to that chart, here's 6:10. At this point, the CAD's weakness started to fall, and the yen's strength was starting to go down. It was less than it was before. As soon as it starts to break out above these, you know, sideways consolidation bars entry, pretty decent place to get in. Now, I probably would have, you know, got out of this trade here when it went sideways, but most of the time counter trend trades work their way back up to the hourly, so you can use the hourly most of the time as your estimated profit target level.